Welcome to the Power Investing Macro Review. Today we're going to cover a good bit more than just the pages we normally cover. Being the end of the year with all the dates aligning with the week, day, week, and month, let's go ahead and jump right in and try to get through some of the data we want to cover today. We would typically start here with the triple play chart on the Power Investing site, but today, since I want to go up a few time frames, we're going to switch over to my TradingView account, where I have the same chart set up, but I can go to various time frames. So I like to always go up and start with the monthly. And here on the monthly chart, we can see we have strong trends across two of the three, the SPY and the QQQ. And the third, the IWM, has really been more sideways than anything as it worked off some of its overbought nature. Now, the SPY and the QQQ have not worked theirs off, but don't look like they're all that excited about doing it right now, especially after the fairly ugly candles in November. They pretty much came back in December and responded strongly. Now, when we flip this down to the weekly time frame, we can see here again the SPY has a very strong trend, strong RSI trend here, but not terribly overbought. The QQQ is the same way, fairly strong, and as I like to call a mushy trend, just keeps going sideways as we get small pullbacks and then moves higher. Typically we see this more in the daily and the 65-minute, but it can certainly happen here as we're seeing now. And then even the IWM off those 2020 lows comes up, and it went into a strong bull range, pulled back right near the bull-bear range test, and has held so far. It can certainly break down from here, which would change the outlook a decent amount, but until it does, it looks right now like it's trying to work its way back towards the high side of this range. Now, dropping down to the daily, we can see here again that the SPY and the QQQ are both still in RSI bull ranges, while the IWM broke down into a bear range, but is trying to move back up this consolidation area. Now, right now, if we roll over here, we've got an RSI negative reversal, which could mean we're heading back down to test these lows again, but a break higher will likely lead us to at least a test of this 60 level, if not a break into a new bull range, if we can get up here into this gap area or close it there. Now, final level we like to look at is the 65-minute level, and on our 65-minute level chart, we can see that all three are still right at the bull range scenario. SPY is definitely still holding it so far. QQQ's in the middle of a hard test right now. Again, we allowed small overthrows since this is markets and probabilities, not exacts. But as you can see down here in the CFG, it's well below zero at this point. Again, can certainly go lower, but a lot of the times this is areas that can find some support. And if you look at the chart here, you can see that this is right at the previous area it tried to break above. So gave some of it back into the end of the year, but we'll have to wait and see if it gives back any more. Now, as we move back to our macro page, again, normally we'd move down here to the breadth, but today I'm going to move us over to the universe page because we're going to look at our equal weight universe a little closer here before we get into the breadth. As we start at the top of the page of the Power Universe, you can see our own equal weight universe of about 2,900 stocks roughly is right up against this polarity area that was the previous breakout, broke above, and then had the failure. Now again, kind of like the IWM, we came back towards the bottom of the range and are now back to challenging this area. This last week has been more flagging action. So if we can break above it, it'd be a good sign. RSI has made its way back above 50, but is not back above 60. We need to see to shift back to a bull range. So a rollover here, we would certainly want to pay attention to going forward. Now, when we do move down into the breadth of the universe, you can see right here, a couple things to note is that the percent above the 20-day moving average, one of our short-term signals, is at 76%, and that's the highest level this has been at since March of this year. And that's kind of becoming a theme. Some of these short-term levels, like the McClellan oscillator, have busted up levels past March. This one's actually back to October of last year. The highs there. And then the Brett thrust is also against a high back in February. These are all the areas where the sideways move in the actual equal weight index started, We had the failed breakout. It came down and tried to challenge the range lows and didn't break them, and now we're back towards the range highs. So this is boding well and building from small up to the intermediate, which is the summation, kind of working its way higher, and made 2 crosses this week, both over the signal line and the 0 line. So that's good news for us. But we just want to see some more of these longer term, like the percent above the 200-day, the advanced decline line, and the new high, new low continue to improve. New high, new lows have made it into positive all week, as well as the 10-day moving average of it is well positive. But the 20-day moving average, 30-day moving average right here is still at about -2, holding down here towards the lows, just below 0. So we'd like to see it move back above 0 for more of a kind of not all clear but clearer sign. Okay, so next we want to kind of move down to the percent making new highs, new lows. You can see here, as we had this double bottom type action and then markets moving higher, we've seen new lows pretty much disappear. So as long as they don't really start expanding back below these previous peaks, then I think we are seeing more of just kind of a rest and consolidation as we move down the levels. Now, moving back over to our macro page, we're going to go down and look at the world view, which the SPY and QQQ up here towards the highs, which is always good to see. But IWM is all the way down to 35 in the world view. So that's not we need to see small caps start to participate a little bit more. Would like to see that at least to see things continue to broaden out. Intermarket, you can see here that the real estate's on top at this point and has been for more than a week. And this is an area that does look like it's strengthening and getting into better shape. But after that, you have SPY, QQQ, and Dow, the majority of the U.S. indexes. The drag here, obviously, is the IWM all the way down at the bottom of this one as well, with even bonds and oil and anything else above it, okay, in the intermarket scene. So again, to see some more of the broad participation would be great, but we are still seeing most equities right up there at the top, and then real estate is the number one area, so we might want to focus a little bit in there and see how those charts look. Now, when we go to our size and style, it's pretty much a large to small and then value to growth. You have mega cap value, then another value sitting on this particular coming down, and then your growth, mid cap value, and then small cap value, and then mid cap growth, small cap. So again, you have a very much a value tent, but it is still a large to small when we view it here. Now, when we go back to the 12-month view, you can see on the 12-month view, you still have growth pretty much at the largest levels leading, but in the bottom levels as well, it goes back to value. It goes to like mid cap value and then growth, and then small cap value and then growth. So it goes more by size as you move down the levels, with value kind of leading. But on the top and the highest levels, growth continues to lead on the 12-month relative strength rankings. And we finally move down into our sector view, the way we view them here. In this particular move, we can see, or this video or macro view, we can see that on the market weighted staples, real estate, and utilities, very defensive still up top. But for what's moving, staples and real estate have really been the ones that have performed the best for the last couple of weeks and kind of moving in the right direction and shaping up real well. Staples is looking like it's getting a little bit out. Real estate just broke out a little bit later, but is definitely moving in a good fashion now. Equal weight sector, we have the similar setup. Healthcare just behind those. Technology and consumer discretionaries are tilted towards the bottom, struggling, and then communication services is the worst across pretty much all of them. But small caps, we see things change a little bit. Consumer staples is up top here, but technology second. And then what we see here on this one, we see the real estate and small cap drop all the way down to the bottom half. So obviously on real estate, the mid cap and higher is kind of the more the focused level there. And then information technology, though, it's really outperforming still on the small cap level as opposed to some of these other areas. But you still have consumer staples and utilities, so still basically a defensive type zone. So I hope this kind of gives you a good idea of what we're seeing from a macro view. The next, we'll talk a little bit more about sectors, ETFs, things of that in the next video. But this should give you a good start as far as kind of where things are leaning going into 2022.